Precious metals just took the lead, and the part that should put markets on edge is that this kind of leadership shift doesn't happen for sentiment reasons. It happens when the plumbing starts to tighten, when hedges get repriced in real time, and when the crowd gets distracted by the headline while the curve is quietly doing something you can unsee. Because right now the story isn't only that gold and silver are moving. The story is that the market is being nudged to dismiss the move as noise, while the mechanism underneath it is turning into a near-term pressure problem. And in a pressure problem, the next week or two matters more than the next year. Later in this video, I am going to give you the simple checklist that decides whether this is a controlled retest you can survive, or the kind of continuation squeeze that gaps over your perfect entry and never looks back. And if one specific level breaks, the math changes. Let's start where everyone starts, and then immediately go one layer deeper. Price. Not as a number, as a message. Gold hasn't been doing that sleepy, polite grind where it creeps higher and nobody notices. It's been acting like a market that found a new gear. Silver, even more so, has been flashing the kind of behavior that tends to show up when the system is rebalancing, not when TikTok is excited. That's the first tell. The second tell is what you hear immediately after. This is just headlines. This is just fear. Rates will cap it. The dollar will crush it. And that's where the conflict starts, because those lines are comforting when you're positioned the wrong way. They're also incomplete when the market structure is shifting underneath you, but that's not the part that matters. Here's the part that matters. In metals, the spot price can look calm while the front end of the futures curve is screaming. The spot price can look like a clean chart while the spreads are telling you the real tug-of-war is happening in the next delivery window, the next roll, the next set of hedges. And when that's the case, the people who are forced to react aren't the YouTube commenters. It's dealers, it's funds, it's industrial buyers, it's inventory holders, it's anyone short paper against the idea that there's plenty of metal somewhere. Because the only metal that matters in a squeeze is indeed the metal that exists in the world. It's the metal that's deliverable in the right place at the right time at a price that clears without somebody blinking. And that's where the real pressure starts. If you've never thought about term structure in your life, good. I'm going to make this simple because the simple version is what makes you money in understanding, not confusion. A futures curve is just the menu of prices for delivery at different times. In a normal world, you often see the curve gently upward, what traders call contango, because carrying metal costs money. Storage, insurance, financing, time. So the later months are a little more expensive, that's just gravity. But when the front end starts to tighten, when the near months start getting relatively expensive compared to the later months, that S, the market, saying something specific, near-term demand for availability is rising, or near-term supply for deliverable metal is being rationed, or the financing and lease dynamics are shifting. It's not magic, it's incentives, it's friction. It is the difference between I can get metal eventually and I need it now. And when the market starts paying up for now, the paper market has to respect it, not because of a conspiracy, because of the math of arbitrage, hedging, and risk management. The next detail is what flips the whole setup. The hidden detail people miss is that metals done at T just rally because people feel poetic about shiny things. They rally hard when the system starts pricing time differently. When the curve flattens, when the spreads behave oddly, when the front end stops acting like a sleepy carry trade and starts acting like a pressure gauge. That is why you can get a situation where pundits argue about inflation expectations, while the real driver is that someone, somewhere, is paying to secure near-term exposure or near-term availability. And the market's response to that is brutal. It forces hedgers to hedge faster. It forces shorts to shorten their time horizon. It forces dealers to adjust how they manage options books. It forces funds to respect momentum because the dip buying machine becomes self-reinforcing. That's reflexivity. That's not emotion. That's math. Now, let's talk why now. Because timing is where most people get wrecked. The calendar is not a side note in metals. It's a catalyst. Late January compresses multiple pressures into one narrow window. Month-end rebalancing, thin liquidity pockets, option-related positioning, and the market's habit of staging its most vicious head fakes when people are emotionally tired and eager for certainty. In these windows, the market doesn't need massive new information to move. It needs imbalance. It needs a small shove. It needs one side to be wrong-footed. And when that happens, the move looks like it came out of nowhere. It didn't. The pressure was building. But that's not the part the mainstream watches. Mainstream watches spot. Mainstream watches a headline about a central bank. Mainstream watches a line about higher for longer. But meanwhile, the people who actually have to make markets are watching whether the front month is tightening, whether liquidity is thinning, whether option strikes are getting pinned and then violently unpinned, whether spreads are paying you to be short time or punishing you for it. And if you have ever wondered why a market can go vertical on what looks like no news, this is it. Dealer hedging and positioning can take a small directional push and turn it into a cascade. Because if the market is set up where dealers are short gamma in key zones, rising prices force them to buy more to hedge, which pushes prices higher, which forces more buying. It's the market chasing itself. It's like a microphone too close to a speaker. The feedback loop screams. And that's the exact moment you'll hear, "This is irrational." No, it's mechanical, and it's not done until the mechanics are satisfied. Now, I'm not going to sit here and pretend I can see every position on every desk. Nobody can. But you can see the footprints. Proof stacking is how you stay credible and stay sane. One proof point is a story. 5 proof points is a thesis. So let's stack them. Proof point 1, the leadership itself. When gold leads, markets can shrug and call it hedge demand. When silver starts acting like the leader, when it moves with urgency, when it stops waiting for permission, that's a signal that the trade is not just safe haven, it's also a market structure and supply chain story. Silver has a double life. It's monetary and industrial. That means it can be pulled by fear and by procurement. It also means it can become a liquid at the worst possible time, because industrial demand doesn't always flex smoothly with price. It flexes with contracts, with lead times, with manufacturing schedules. And when that machine tries to secure supply, it doesn't negotiate with your chart. It pays up. But that's not the only proof. Proof point 2, the curve and the spreads, conceptually. Even if you never look at a spread chart, you can understand what it implies. If the market is rewarding you for being short time, if the front end is tight relative to the back end, the market is telling you near-term availability is being priced with urgency. And in that environment, paper selling can temporarily push spot down, but it struggles to break the structure unless the underlying pressure releases. That's why you often see aggressive dip buying in metals when the broader tape is nervous. It's not just gold bugs, it's the system responding to time pricing. And that's where the real pressure starts. Proof point 3, inventories and the deliverable question. People love to say, there's so much metal in vaults. And sure, there is metal in vaults. But here's the uncomfortable truth. Big stock numbers do not automatically equal easy deliverability. There are categories, there are ownership structures, there are logistical frictions, there are bars that are eligible in the sense they exist, but not registered or committed for delivery in the sense the futures mechanism can access them without someone making a choice. And choices are expensive when the market is tight. Because to make metal deliverable, someone has to give up optionality. Someone has to give up the chance to sell later at a better price. Someone has to accept financing terms that might not be attractive. So even in a world with large total stocks, you can get tightness in the slice of inventory that actually matters for settlement and immediate transfer. That's not a conspiracy. It's a supply chain reality, but that's not the only proof. Proof point 4, institutional behavior. The most powerful bids in metals over time have not been retail. Retail can add fuel, sure, but sustained leadership tends to come from institutions and sovereign behavior, allocations, reserve decisions, hedging programs, and the slow grind of portfolio insurance. When institutional money wants exposure, it doesn't announce it on social media. It uses vehicles that drip by, that roll exposure, that add on weakness and rebalance on strength. That can show up as the dip won't break. It can show up as every flush is bought. It can show up as the market refuses to die. Oh, and when that's happening while the macro narrative is supposedly unfriendly, that's a tell. But the next detail is what flips the whole setup. Proof point 5, cross-market comparison. Watch what else is happening when metals lead. Are real yields falling cleanly? Sometimes yes, sometimes no. Is the dollar collapsing? Not always. That's the point. When metals are leading without the classic textbook tailwinds lining up perfectly, you should suspect something structural, a confidence premium, a supply availability dynamic, or a positioning squeeze that doesn't need permission from the macro consensus. It's the market saying, even if you think the model says I shouldn't go up, I'm going up because the system requires it. That's the vibe you respect. That's how you keep your account intact. Proof point 6, the chart structure itself. You don't need fancy indicators to read structure. A market that S breaking out tends to do one of two things. It either continues straight into a squeeze, or it pulls back to retest the breakout zone, shakes out weak hands, and then continues. What matters is not whether a dip happens. Dips always happen. What matters is whether the dip finds demand quickly, and whether the market holds above the prior decision zone. That's the difference between trend signal and noise. And in metals, the noise can be violent, but that's not the part that matters. So what does all this force participants to do right now, this week, this month? It forces time compression. It forces risk managers to shorten leashes. It forces shorts to stop thinking in months and start thinking in days. It forces dealers to react faster to spot movement because their option exposure is sensitive near key strikes. It forces industrial buyers to think about procurement timing rather than waiting for a better price, because waiting can mean paying more later if the market gaps. And it forces the broader market to accept that the leadership is not random, it's information. Now, let's address the skeptic's voice in your head, because you need that voice. The skeptic is what keeps you from believing fairy tales. The skeptic is also what the market uses to scare you out at the wrong time. Skeptics will say, rates can rise, the dollar can rally, metals will get crushed. And yes, those are real risks. Metals can get slapped down hard. They can whip around violently, even if the longer-term thesis is correct. They can do a brutal intraday flush that feels like the end of the world and then close green like nothing happened. That's not manipulation. That's how a market behaves when liquidity thins and leverage exists. If you don't respect that, you'll get emotionally harvested. Here's the psychology shield you need. If metals are in a structural move, volatility becomes a weapon used against you. The market will try to convince you the thesis is dead with a single red day. It will use headlines as timing tools. It will drop the price into a zone where stops live, trigger forced selling, and then rebound when the forced selling is exhausted. It will do this especially around calendar windows, end of week, end of month, option-related dates, because that's when positioning is most sensitive and liquidity is easiest to exploit. If you want to survive, you have to separate trend signal from noise. Trend signal is structure, higher highs and higher lows, successful retests, tight dips that are bought. Noise is the violent wiggle inside the structure. If you confuse the two, the market doesn't just take your money, it takes your confidence, and that's the real cost. Now let AS talk the mechanism that can make this move feel unfair: short covering and margin pressure. And when a market rises, shorts lose money, that's obvious. What's less obvious is how quickly that loss turns into forced buying. If the move is sharp and liquidity is thin, margin requirements can bite faster than people expect. Risk managers demand reduction. Funds de-risk, dealers adjust. Shorts cover. Covering is buying. Buying pushes price higher. Higher price worsens losses for remaining shorts. That creates more covering. That's a spiral. And in metals, because the market structure includes futures, options, and sometimes physical hedges, the spiral can involve multiple layers of forced behavior at once. This is why certain rallies feel like they are pushing through resistance that should have mattered. The resistance mattered. It just got overrun by forced flows. And that's where the real pressure starts. So let's make this practical. How do you watch this without getting hypnotized by every tick? You use tripwires, not heroic targets. Tripwires. Because targets make you stubborn. Tripwires make you adaptive. In gold, the key idea is this. The recent breakout zone becomes the line in the sand. I am not going to pretend there has one magic number. Different feeds and different products show different prints, but you can identify it on any chart. The last major consolidation that broke upward. If gold pulls back into that zone and holds, if it wicks through and then reclaims, if it spends little time below, if buyers step in aggressively, that's structural strength. If gold breaks below that zone and stays there, if rebounds are weak and sold, if the market starts making lower highs, that's weakening. Not doom, but weakening. And the next detail is what flips the whole setup, how silver behaves during that test. Because silver is the stress barometer. In a healthy metals bull move, silver either holds up better than you expect, or it recovers faster than you expect. If gold dips and silver collapses and stays collapsed, that's a warning that the move might be more risk-off hedge than systemic repricing. If gold dips and silver refuses to die, if it snaps back, if it holds key round number zones, if it prints aggressive buying on weakness, that's the market telling you the bid is broader and more structural. And when silver leads, the market isn't just hedging, it's repricing pressure. Now the near-term roadmap. You need 2 scenarios, you don't need 10, 2 keeps you calm. Scenario 1 is the controlled pullback and retest. This is the market letting off steam. It shakes out late buyers. It lets funds rebalance. It lets dealers reduce risk. It lets the narrative cool. In this scenario, you see dips that find buyers in known zones. You see stabilization near the breakout region. You see a basing pattern that looks boring and then resolves higher. The confirmation here is simple. Higher lows form, the market stops making new intraday lows, and breakouts are respected rather than instantly faded. The invalidation is also simple. The market fails retests, breaks below the prior decision zone, and can't reclaim it with authority. That's the controlled case. It's survivable. It's the one that frustrates everyone because it feels slow until it isn't. Scenario 2 is the continuation squeeze. This is the one people will deny is happening until it's already happened. In this scenario, the market doesn't give you the clean retest. It stays elevated, consolidates tightly, and then rips through the next resistance band when liquidity is thin. It can gap. It can print a move that makes your brain reject reality. Confirmation looks like this: shallow dips that are immediately bought, front-end tightness that doesn't relax, silver staying bid, and breakouts that accelerate instead of stalling. Invalidation looks like an exhaustion blow-off followed by a sharp reversal that fails to reclaim the breakout zone, a sign that the squeeze burned itself out and liquidity is now punishing late leverage. And that S where the real pressure starts, in the emotional moment when you want certainty and the market refuses to give it. So what do you actually watch in the next 1 to 2 weeks? Here's the checklist that keeps you from staring at every candle like it has a moral judgment. First, watch whether the market is pricing time with urgency. You don't need a spreadsheet, you need a feel. Are near-term moves being defended quickly? Are dips in the front month bought faster than dips in the back month? Do you see that snapback quality that suggests short time is uncomfortable? If the answer is yes, the structural bid is still there. Second, watch silver's behavior on down days. This is the tell that separates gold-only fear bid from broad repricing. If silver bleeds out quietly, caution. If silver gets hit and then rebounds hard, respect it. Third, watch the narrative. Not because the narrative controls the market, but because the narrative is what will be used to manipulate your emotions. If the tape is strong and the headlines are dismissive, that's often when the move has the most room. If the tape is euphoric and everyone is suddenly a metals expert, that's when you tighten your discipline. Fourth, watch liquidity moments. Late week closes, month-end flows, any major policy communication window. These are the moments where the market chooses violence because it can. If you get a sudden flush into one of these windows and it immediately recovers, that's a strength signal. If you get a flush and it stays heavy, that's a warning. Fifth, watch the prior decision zones on the chart. Again, not one magic number, zones. The most recent consolidation that broke upward. The most recent swing low that held before the acceleration. Those are your tripwires. Above them, the thesis is intact. Below them, you reassess. That's how you keep your ego out of it. Now, let's deal with the counterpoints honestly, because this is where trust is earned. A metals rally can fail for clean, boring reasons. Real yields can rise. The dollar can strengthen. A policy surprise can pull liquidity toward cash. Risk assets can crash in a way that forces indiscriminate selling, yes, even of gold, because margin calls don't care about your thesis. Industrial demand can slow, especially for silver, if manufacturing expectations roll over or if higher prices trigger substitution at the margin. And if the market's front-end tightness relaxes, if spreads normalize, if the curve steepens in a way that signals no urgency, then the pressure narrative weakens. None of that means metals are finished forever. It means your near-term setup changes. And in trading and investing, the near-term setup is what decides whether you keep your capital long enough to catch the big move. Here's the emotional trap you must avoid. Confusing I am right with I am safe. Don't! You can be right about direction and still get wrecked by volatility if your time horizon and your risk done a T match the market DS behavior. Metals are notorious for this. They're the masters of the fake breakdown and the face rip. That's why the psychology shield matters. If you're going to participate, you don't do it with fragile leverage and blind certainty. You do it with a plan that assumes the market will try to shake you, because it will. The market doesn't punish you for being wrong. It punishes you for being sloppy. And that's the part no one wants to hear. Now let's zoom out just one notch, because the broader implication of metals leading is what should make macro watchers pay attention. When gold leads, the market is often pricing some mix of confidence risk, currency stress somewhere in the system, or a shift in what investors consider real collateral. It's not always inflation. Sometimes it's the perception of policy limits. Sometimes it's geopolitical risk. Sometimes it is the slow realization that liquidity is being rationed in a world that pretends it isn't tea. And when silver joins, it adds an industrial edge that says, this isn't just fear. This is demand meeting friction. That's why markets on edge is the right phrase. Because metals don't just reflect anxiety, they can cause it. They tighten financial conditions psychologically. They change what people believe about purchasing power. They make other asset classes feel less stable. And that feedback loop matters. So where does that leave you right now? It leaves you with an edge if you stop staring at the headline and start watching the mechanism. If you're waiting for mainstream confirmation, you're late by definition. Mainstream confirmation is what shows up after the move has already forced everyone to acknowledge it. The better approach is to watch the quiet tells: curve behavior, dip buy quality, silver's resilience, and the calendar windows where liquidity can exaggerate the next shove. And here us the subtle truth that separates pros from tourists. The market will try to use your identity against you. If you see yourself as a skeptic, it will bait you into fading a move until the pain forces capitulation at the worst time. If you see yourself as a believer, it will bait you into holding through obvious warning signs because you want the story to be true. The antidote is not cynicism or faith, it's conditional thinking. If this holds, the thesis strengthens. If this breaks, I reassess. That's it. That's the whole game. One more thing before we close, because it's the metric everyone ignores. Stop treating the spot quote like it means the whole truth. Spot is the headline. The curve is the sentence. The spreads are the punctuation. When the punctuation changes, the meaning changes. If the market keeps pricing urgency in the near term, if that tightness persists, then dips are more likely to be bought, shorts are more likely to be pressured, and breakouts are more likely to stick. If that urgency fades, the rally can turn into a chop, and chop is where impatient money gets bled out. So here's your near-term playbook in plain English. Expect violent whipsaws even if the thesis is correct. Don't confuse a single red candle with failure. Watch whether the market can hold its recent breakout region in gold. Watch whether silver holds key round number support zones and rebounds with energy. Watch for the controlled retest versus the continuation squeeze. If you get the controlled retest and it holds, that's structural. If you don't get the retest and the market keeps squeezing, respect the gap risk and don't let pride talk you into chasing blindly. And if the key zones break and fail to reclaim, don't argue with it. Reassess. That's risk management. That's how you stay in the game. And if you're the kind of person who wants markets explained without the fairy dust, mechanics first, narrative second, then you're already in the right room. Keep your eye on the pressure points, not the applause lines. Because if precious metals keep leading from here, it won't be because everyone suddenly likes gold. It'll all be because the system is being forced to price something it can talk its way out of. And that's when markets really go on edge.